Leading our discussion will be James Roberts, Research Fellow for Economic Freedom and Growth in our Center for International Trade and Economics. He focuses on the production of Heritage's annual Index of Economic Freedom. He also studies economic and political issues in Latin America and Europe, as well as development assistance and nation-building issues. Before joining us here at Heritage, he served in the State Department for 25 years, having tours of duty at U.S. embassies in Mexico, Portugal, France, Panama, and Haiti. He has also helped coordinate several major U.S. assistance programs, including efforts to reform East European economies and to reconstruct Iraq. He is also a Navy Reserve member from 1982 to 1993. Please join me in welcoming James Roberts. Jim?
Thanks very much. Well, it's a real pleasure to welcome Daniel Lakai here to Heritage today. Daniel has a PhD in economy, and he is an investment fund manager. He's a certified international investment analyst. He has postgraduate degrees from IESA at the University of Navarra and master's and PhD degrees in economic investigation from the Universidad Católica de Valencia. He is a chief economist at Traces SV. He's a fund manager at Adrisa International Opportunities. He's a member of the advisory board of the Rafael del Pino Foundation in Madrid. He's commissioner of the Community of Madrid in London, where he splits his time between London and Madrid. He's a member of the advisory board of the Hispano-American College's Business School, president of the Instituto Mises Hispano, professor at the Instituto de Empresa Business School, the Instituto de Estudios Bursátiles, I guess that's stock market, and at UNED, also a lecturer at the London School of Economics. He is ranked top 20 most influential economists in the world in 2016. He has nearly a quarter of a century now of energy and finance sector experience in North Africa, Latin America, and the Middle East, and a fund manager overseeing equities, bonds, and commodities. Voted top 3 generalist and #1 pan-European buy-side individual in oil and gas, Thomson Reuters Extel survey, a leading survey among companies and financial institutions. And he's the author of 3 best-selling books: Life in the Financial Markets, The Energy World is Flat, and the book we will discuss today, Escape from the Central Bank Trap. And there are copies for sale outside if you would like to get one. I'm sure Daniel will be happy to autograph it for you. He's also a regular collaborator with CNBC, with the World Economic Forum, Epoch Times, Mises Institute, Focus Economics, El Español, The Commentator, and the Wall Street Journal. And you can visit Daniel's page on Amazon, his author page, or his website at dlakai.com. It's a special honor for me to welcome Daniel here today. Daniel moderated and helped me present our Index of Economic Freedom earlier this year in Madrid at the Fundación Rafael del Pino. And so I'm grateful that you've come to see us, and I'd like to turn the stage over to you now for your presentation. Thank you.
Thank you very much. Thank you, Jim. It is an honor for me to be here today at the Heritage Foundation to talk about this book, Escape from the Central Bank Trap. The Heritage Foundation is an integral part of the defense of freedom and the meritocracy and individual initiative. And this is a very important topic that we tend to forget about many times because when we think of economic freedom, monetary policy is an integral part of it. And we need to pay a lot of attention to what it does and what it creates in terms of risks to the world, and obviously what it generates in terms of benefits. The idea behind this book started when I looked at the basic numbers around what central banks were doing globally. And I found that for the first time in history, in a period in which there is no recession, no crisis, and no general problems within the financial sector, the major central banks all around the world are increasing money supply by around $200 billion a month. Mm? This is unprecedented. We have seen an increase in money supply globally in the last 10 years that is higher than all of the money supply increase of the last 3 centuries. And that is obviously something that we need to pay a lot of attention to. The reason why we need to pay a lot of attention to this is because we are hearing all the time that this is not a problem because there is no inflation. And as Milton Friedman used to say, inflation is taxation without legislation. But we are not paying attention and not paying enough attention to the real problem of the massive level of inflation that is being created in financial assets. If we look today at the world, the combined valuation of bonds and stocks globally is at an all-time high. Valuation being considered within bonds as obviously the level of yield, the low yield that they have relative to the market. It is an environment in which today, if you look at the least risky assets globally, you will find that you would have to go sometimes to 10, 20 years before you start to get any real interest rate, real yield. So what we are seeing is a massive transfer of wealth from savers to governments and the indebted sectors. And the idea that monetary policy is there to help get out of a very aggressive financial crisis and get out of a problem of excess debt, to buy some time to reduce debt, is basically debunked by reality. Because very low interest rates and very high liquidity, the only thing that they have done is to incentivize debt. The level of debt globally is around 320% of GDP right now. And what we have seen is that around the world, lowering interest rates has a constantly diminishing return in terms of growth and in terms of job creation. It is very simple. You might have a view that lowering interest rates is something that helps an economy in an environment in which there's too much risk. But lowering interest rates from 10 to 5 doesn't have the same impact as from 5 to 1, let alone from 1 to 0. And we need to pay attention to what we are trying to achieve by lowering interest rates and by increasing money supply. The first thing that we need to think of is, if we are going to be lowering interest rates to 0, what type of business was not profitable at 1% interest rates that needs 0% interest rates? Is what kind of investment are we incentivizing? And the answer is a very dangerous one. Is a very dangerous one, because what we are seeing is that the investment process, instead of going to high productivity, high added value sectors, goes to the weakest parts of the economy, to the sectors in which of very low productivity and very poor growth. It is not a surprise that if you look at the world, the massive increase in money supply has come at the same time with a massive reduction in money velocity. What is money velocity? The number of times that that a unit of currency, of money, moves around the economy. Why does money velocity collapse? Why does inflation not increase? Why are real wages not going up when employment is coming down? Why, in general, we are not seeing companies invest more or consumers spend more in an environment of extremely low rates and in an environment of extremely high liquidity? Is everybody stupid? The first problem is that central banks make their calculations about what is the necessary level of investment, the necessary level of growth, the necessary level of inflation based on historical data. And the idea is that the same policies that have been applied for 50 years are going to work exactly the same in the next 50 years. But they don't, because we all know what the law of diminishing returns is. You may be provided with an environment of extremely low rates, but if there is not a real need for new investment, you are not going to spend the money in new capital expenditure. If there is a real need for investment, it is not going to come by incentivizing it through low rates. It is not going to come by incentivizing it through massive liquidity. But let's start from a very simple premise. If you think that a central bank buying bonds is going to create employment, it is exactly the same as to think that it's going to rain if we all start dancing and singing together. There is absolutely no correlation or causation between one and the other. The Central Bank of Japan, as of today, owns 60% of the ETFs of the country. It is on its way to owning 90% of GDP in terms of its balance sheet. The European Central Bank's balance sheet is now around 35% of the GDP of the European Union. Buying bonds is not generating the level of growth and the level of inflation that they're looking for, first and foremost, because lowering interest rates and increasing money supply is perpetuating overcapacity, the first thing. What happens in an environment like the one in which we live today if you have a failing business, you go to your bank and you say, here are the keys of my business because it's not going well. The bank manager will say, hold on a second. I don't want those keys. I don't want the keys. Let's talk. Let's refinance. Let's go through this. Let's move this forward. Let's kick the can forward another couple of years to see if things improve. You might think that that is a good thing. You might think, hey, that is not a bad thing. You maintain jobs. The business keeps going. That's fine. Now, think about it if you multiply it all over the economy and what happens. What happens is two things. First is that those businesses become zombie companies, that the risk that we are creating in the economy is hidden because the central bank is lowering rates and increasing liquidity. So the perception of risk in the economy from the numbers that the central bank receives looks small. But what happens is that entrepreneurs, consumers, savers do not see that those things match, do not see that those lower rates are an opportunity to get into more debt or to consume more, but to save more. They do not see an opportunity, companies do not see an opportunity from very low rates and from high liquidity to invest a lot more. They see an opportunity to buy back shares and to increase dividends, which makes total sense. If you think about it, perpetuating overcapacity and increasing the number of zombie companies makes the cost of equity of a company go up, not down. So it is more, despite the fact that interest rates are low and that liquidity is very high, most companies are not seeing that their weighted average cost of capital come down. That level of overcapacity should not be a problem if we have engines of growth globally that absorb that overcapacity because there's higher demand, more interest for our products, etc. What is the problem of monetary policy and the law of diminishing returns, and especially what I say in the book, the pyromaniac firefighter activity of central banks, which which is central banks first lower rates, massively increase liquidity. There's a financial shock, and then they present themselves as a solution. The pyromaniac firefights, that's what I call it. So what is the problem? The problem is that the overcapacity that we created in the OECD, in the large economies, in the developed economies, based on a growth that was going to come from China, that was going to come from emerging markets, we have transferred that overcapacity to the emerging markets and to the growth markets. So now, China faces the same problem that Japan, that the OECD faced a few years ago, which is an enormous level of overcapacity and very high debt. China today requires 4 units more of debt to create 1 unit of GDP than 8 years ago. So this is the problem, is that we say, look, it doesn't matter because we are increasing the level of debt, but the world is not entering into a recession. There's some growth happening. That's fine. That's fine. Now, where does the problem start? The problem starts when you cannot repay that debt. And monetizing it, i.e. getting central banks to absorb it within their balance sheet and letting it mature and go to infinity, monetizing it creates a sense of lack of fairness within the market. Very simple. If you are in a business, if you are a consumer, what you're seeing, the other side of the same coin, the other side of the coin of monetary policy and financial repression is fiscal repression. Because it is not true that governments with fiat currency can issue all the money that they want and monetize all the debt that they need without creating any problem, because the purchasing power of currencies collapses. Every time that I speak with friends in Japan, or we talk about Japan, we think, why is a country that has so little unemployment, that a country that has such high level of real wages, that has such level of productivity, why is a country like that not growing further and not consuming more? And why are companies not investing more? And a friend of mine that I mentioned in the book from a Japanese bank said to me, because they're not amnesiac. Because they know. Because they know that low rates, that they have had zero interest rate policies for 2 decades, are not going to create more growth. Because they know that the central bank doesn't print growth. More importantly, they know that central bank and monetary policies don't disguise the fundamental trends in economies, which are the demographic trends, the level of real available assets and real disposable income of families, and overcapacity. It doesn't disguise it. It just keeps it sort of quiet for a while. But then there's a point in which the cracks start to appear, because everybody would be happy if this situation did not create any imbalances. But the imbalances happen, and they're very, very, very large. The first one is trillions of dollars of negative yielding bonds in our pension funds, in everybody's retirement plans, etc. Why is that such a negative? Because if you are having to invest more and more into riskier assets to achieve a little bit of return, the moment in which there is some sort of blip in the markets, you are completely destroyed. Think about it this way. The most conservative investor is obviously the bond investor, the pensioner, the people who just want a little bit of return. So that return is just gone because of monetary policy. If you go today to Europe, you would have to go to 30-year maturities to have a real a real positive return relative to inflation. And you have more than $9 trillion of negative yielding bonds in the European economy. So think about this for a second. As an investor, you need to get, you're almost in a running to standstill situation. They say that there's no inflation, but as a friend of mine says, everything that I pay goes up and everything that I earn goes down. Why? Because the purchasing power of the currency is coming down, while the lack of inflation happens in the tradable goods, but in the non-tradable goods, inflation is actually quite high. So in the things that you actually buy on a daily basis, you see that inflation is much higher than what the CPI dictates. Why? The CPI is an average. CPI is an average of food, clothes, education, healthcare, a number of things that you buy, then leisure, technology, number of things. Okay, it's an average. The beauty of averages is that if food prices and clothes and education and healthcare go up 10% and televisions go down 20%, there's no inflation. That's the beauty of averages. The problem of averages is that is what shows why societies all over the world are reacting so aggressively, politically, to a situation that they don't understand. Because think about it. We're here in the United States. I live in between London and Spain. Imagine when we look at the U.S. economy, we all feel very, very envious. Huh? We feel, oh my gosh, 4.5% unemployment, 4% right now, 2% growth, etc. And with all those fantastic numbers, Trump. What the hell? Germany right now, no? Germany right now. It's almost almost absolute employment. The economy is growing, and industrial production at multi-year highs. Everything is great. Oh my gosh! Merkel now needs to get a coalition, and the alternative for Germany is going up in the polls. People feel financial repression. They might not understand it, but they feel it. They see that their wages are not going up while they say that everything is going well. They see that their ability to consume more is not improving, despite the fact that they're telling you that that the world is fantastic. And more importantly, the fallacy of the wealth effect. So what they say, what monetary policy is aimed at the following. You put a lot of money into the economy that is going to make house prices go up, that is going to make market prices go up, stock prices and bond yields will go down, that will free some money into the economy, that will have more money to lend to the real economy, that there will be more for, and that will create jobs, and that will increase wages. What doesn't, but all those steps in the process don't get to the average citizen. And why they don't get to the average citizen? Because of what we mentioned before. Demographics, overcapacity, and the overall effect of debt saturation. So what ends up happening is that stock prices go through the roof, bond yields go down, fantastic, house prices go up, and guess what? The average citizen, less than 9% of its wealth is in those assets. Where is most of the wealth of the average citizen in the OECD? In deposits. In deposits. And if you have most of your wealth in deposits and the purchasing power of your currency is being destroyed and the amount of money in the system is being increased dramatically, you are getting poorer. You are being made poorer. More importantly, because asset prices are going through the roof, it is more difficult for you to achieve the possibility of getting those assets. A house, you name it. So it is very important for central banks to look for solutions in which we don't continue to perpetuate the perverse incentive that is being created right now. So what is the perverse incentive? Anyone that works in the markets knows it. Every time that you read a bad piece of news on the economy, what is the first thing that you do? It's called BDJ, buy the junk, with a D as in DA. No, it's very. Why do you buy the junk? Because if the economic news flow is negative, and you believe that central banks will have to print more money and lower rates further, what are the assets that are going to perform better? The bad ones, the most indebted companies. That's why high yield bonds are at 35 lows in terms of yield right now. That is, as 35-year highs in terms of valuation. Despite the fact that, according to the Bank of International Settlement and according to the rating agencies, the ability to repay the debt has not improved, has actually gone down. And the rise of zombie companies has led us to get to 9% of all traded companies being zombie companies, which is companies that cannot pay their interest expense with their operating profits. Can you imagine at 0% interest rates and with massive liquidity, what type of company it is that cannot pay its interest expense with its operating expenses? It's not a zombie. I mean, a zombie at least walks. Yeah, at least the ones that I see in The Walking Dead, no? Yeah? It's like The Walking Dead Series 7, Season 7, which the zombies are not even, like they're not even the story anymore because they're rotten. They're gone. We have a serious problem because the only thing that keeps this all together is credibility. The only thing that keeps it all together is credibility. And let's think about it. The fact that today, after the atrocious track record of central banks of projecting the outcome in terms of inflation, in terms of unemployment, in terms of growth, in terms of credit growth, etc. After that atrocious track record, I show it in the book. It's called the fallacy of the hockey stick. It's a hockey stick like this. Where the base continues to go down, but there's always next year improves. Next year. In 2020, don't worry, real wages will go up. It's glued by credibility. So let's be at least thankful about the fact that there is still some credibility left and that people continue to believe in that hockey stick at a certain level. But the risk of losing it is very big. And once you lose it with extreme monetary policy, what happens is that if you lose credibility, you get into the problems that we have seen over history all over again. Economic depression, big risks of inflation going the wrong way, a financial crisis, obviously, because inflation is not in prices, but it is in financial assets, etc., etc., etc. So this book is not just about criticizing, it's about solutions. And the first thing that we need to do to provide solutions is to know where the environment in which we live in. And the environment in which we live in is obviously central banks are not going to disappear. If you talk with an Austrian economist, they say what they have to do is just close the door. Well, it's not going to happen. So let's not talk about science fiction. Let's talk about reality. What can they do to avoid the next and monster financial crisis that would happen if they continue this way? The first thing that they need to do is to put forward guidance and their views of what is going to, of the objectives that they have with the monetary policy in the things that they actually do have an influence on. Let's forget about this whole complete nonsense of unemployment and no, it's not. I mean, it's not. Seriously, a central bank doesn't create jobs. You guys create jobs, companies create jobs, not a central bank. And zero interest rates onto it. The credit growth, what type of credit growth? What type of credit is being created? What type of what type of valuations of assets are they seeing relative to reality and the ability to pay? What is happening with the stock market? What is happening with the bond market? That's what they need to talk about. The things that they are actually influencing. Are home prices going up because people have more money, or are home prices going up because funds are buying houses to get a little bit of yield and therefore create another bubble? So those are the things that they need to pay attention to. The second thing that they need to pay attention to, every time that a central bank says, we don't see any risk of bubbles, run away. Why? Because they've never, and I mean never, ever, identified one. So that's the first problem. The second problem is not just, okay, fair enough, we're not very good at predicting bubbles. Okay, fine. No, the second problem is not just not predicting them. The second is ignoring them. Is to think that the stock market is through the roof because the world is great, or that bond yields are super, super low, and that you can buy today at a very reasonable 0.5% bonds from a country that was virtually bankrupt 2 years ago. So you need to pay attention to the bubbles that are being created, and you need to pay attention to this risk of markets behaving in the buy the junk policy, because they do. The third thing that central banks need to do is to be systematic. And I'm sorry, because that takes a lot of power, and it takes a lot of let's say, positioning and prestige. I don't know what type of prestige, but it takes a lot of the name dropping out of the governor of the central bank. If policy is that you're going to start in this month and you're going to end that month according to certain metrics, you don't extend it just because markets are volatile, because you are creating the perverse incentive. You see, if today, for example, in the US, if you say you're going to increase rates 3 times, you increase it 1, and you increase it only 1 time, and you're still almost 3 points behind the curve, that is behind inflation, where inflation would dictate the market prices for interest rates. If you don't do that, the problem that you're going to face is that the bubble that you are creating, you are not going to be able to appease it by lowering interest rates or increasing liquidity. Think about it. If today we have a financial crisis, what can central banks do? Oh, don't worry, we'll lower interest rates. I'm sure it's going to work. From 0 to minus 0.5%, I'm sure that people will run away, run down the street to invest and to buy. So it's not going to work. And that law of diminishing return, that's why you need to be more systematic. And that's why I think that central banks should go very strictly through a Taylor rule by which the perverse incentive to keep it, because nothing is, what's the problem because there's no inflation, doesn't become the genesis of another crisis. That is basically, I'm not going to, obviously, I'm hoping that you buy the book, so there's many more things that I say, but basically what we need to be is a lot more systematic and think that money supply is not just something that can be increased forever without any risk. The risk of building problems and kicking the can further in the balance sheet of a central bank or in the balance sheet of commercial banks is exactly the same. It is exactly the same. And when it bursts, it creates the same problem. So Escape from the Central Bank Trap is a book about opportunities. It's a book about rebuilding the middle class. We cannot just continue to believe that the world is going to be surviving if the middle class continues to pay for the excesses of high government spending and big monetary policy mistakes. But more importantly, it's a book about solutions within the current framework and a way of escaping from this running to standstill policy by which people take increasingly more risk for increasingly lower returns. At the end of the day, central banks are not the solution to the economy. Central banks only provide a certain level of support. The economy is about companies, it's about consumers, and it's about getting things back to incentivizing productivity, not incentivizing debt. Thank you very much.
Well, thank you, Daniel. It's a fascinating and depressing performance. Sure, there are many questions people have, and I think we have a few minutes to take some, so who'd like to start? I mean, I'll ask one just while you're thinking. So, did you drill down a little bit about this problem of deflation of so many trillions of dollars in euros and yen being printed? Why? Is it because of China's entry? What's the cause of this deflation?
We need to differentiate between deflation and disinflation, and it might look, technical, but it's a big difference. Yeah. For example, technology creates price disinflation. Is that a bad thing? No. Well, we're going to have the iPhone X is about $1,200. That's price inflation, probably hyperinflation. But the reality is that when that phone comes out, the prices of its competitors and different other ranges of perfectly functional and very, very, very good phones is going to be coming down by 35, 40, 50, sometimes 70%. Is that a bad thing? No, it's actually a great thing. Okay, so technology disinflation is not a bad thing. Is it a bad thing that we are able to purchase better and more quality goods because there is more competition? No. The problem would be if disinflation was created by constantly lower wages and decrease in productivity. Well, that is also happening. Now, the problem is that central banks are presenting the solution in the wrong way. Why? Because of what I said before. Instead, the monetary policy that they're following, instead of putting a curb to the decrease in productivity growth and to improve real wages, they are concentrating on preventing a blip in financial assets. By doing that, and house prices and perpetuating overcapacity in low productivity sectors, what happens is that if you are protecting low productivity sectors, where do you invest if you have some money? In low productivity sectors. If the central bank is giving you the signal that what is going to be protected through its policy are those low productivity sectors, people will invest in low productivity sectors. And therefore, all those things will continue to happen. Overcapacity, that creates lower inflation, etc. Is China to blame? Not necessarily, because if you look at many other countries, you will see that the impact that China is making in prices is very small. Is much higher the impact that domestic economies are making on prices through perpetuating overcapacity. So I don't know if anyone here in the audience has ever left the supermarket saying, "Damn, meat prices are down." And I don't know if anybody here has ever left the service station saying, gasoline prices are down, it's intolerable. Obviously not. First, there's no problem in lower prices. Who is not benefited by lower prices? The indebted sectors and the government. Because the government debt gets deflated through inflation. Inflation is taxation without legislation. So what we need to think about is First, monetary policy is not going to change this trend. Second, what can change the trend that we do care about, which is low productivity and overcapacity? Definitely not continuing to lower rates. We need to increase rates, improve the positioning of high productivity sectors. And yes, obviously, there will be some corpses in the process, but it is a very important process to start to rebuild that improvement in productivity.
Yes, my name is Francisco Lara. I'm a visiting professor here at Catholic University at the Business School. I know very well Daniel. Thank you first for the lecture and the book. I just want to ask if you can explain with more detail a little bit when you say that the 90% of the savings of customers are in deposits.
In deposits.
So, in which ones? So.
Yeah, in your bank account. In your bank account, in deposits, or in money funds. So most of the citizens in the world, most of the middle class, has their savings, one, obviously in a home, and two, in deposits, and third, but very distant, in a pension fund. Now, think about those three. The deposits. 90% of your savings. Why? Because you're saving for a rainy day. You don't know if something is going to happen. Therefore, you keep some money in your bank account to cover for anything that you might need. And obviously, that is not going to change. But debasing the currency and destroying the purchasing power of a currency definitely affects that, because you are more prudent. You become more prudent. You don't become more risky because the value of your deposits is coming down. You become more prudent. Second, pension funds. You have a pension fund, usually in government bonds or in very low risky assets. If those low risk assets are giving you negative real returns, you become even more prudent. You don't go out there and say, yeah, let's buy some small cap pharma stocks. You don't do that. Or gold miners. Now, sorry for those sectors, but you don't do it. You don't do it. Even if it's value, because you're as a saver, your tolerance for volatility does not exist. And by the way, and central bank policy actually decreases your tolerance for volatility. I was called the other day by television in Spain, and they said to me, "Would like to do an interview about the collapse of the stock market." I said, "What collapse of the stock market? I don't understand. What is happening? Maybe I've missed it. Oh, it's down 2.5%. What do you mean 2.5%? What is that? What is it? Collapse. I mean, seriously? Collapse? Your tolerance for volatility is very, very low. It is so low that we've had a blip in the market in August, and our clients were calling all over the place about what the hell is happening. Because you only expect asset prices to go up because of monetary policy. So something is not computing. Therefore, you become less prone to risk. You become more conservative.
And Alex, and then if you could identify yourself.
Alejandro Chafuen, president of the Atlas Network. Again, congratulations on your clarity on this difficult topic. Two questions. If some of your libertarian friends will see the title of the chat, escape from central banks, well, what role for Bitcoin, and cryptocurrencies, and are they a challenge to central banks? And the second one is, how do you think this monetary policy of this last years has affected equality and mobility in the major economies?
I'm going to start from the very difficult questions, both. But the second one, equality. Obviously, if monetary policy is fueling the financial asset bubble and is incentivizing debt and is incentivizing credit, who benefits from it? Whoever has access to financial assets and credit. So the most indebted and the participants of financial markets. Logically, who who has seen his wealth go up by 200% with the S&P 500? Huh? Well, not many people, actually, not even the market participants, because you get scared, but not the average citizen. Hmm? So it is normal that monetary policy, when it comes on top of it with financial, not just financial repression is lowering rates and increasing money supply, but fiscal repression. So governments enter into massive deficits, very high levels of debt. Monetizing that debt does not help their fiscal situation. They say that they're going to increase the taxes on the rich, and then what happens? What happens all the time? You say you're going to increase taxes on the rich, the revenues that you estimate that you're going to make, you don't get them, so who do you raise the taxes to? To the middle class. So the middle class ends up being in the one who pays for the mistakes of monetary and fiscal policy. So that's the problem. That is a problem that is not going to be solved by, because this is the situation that we see right now is that we hear a lot of people say, okay, so the problem is that most of the money creation goes to financial assets, so let's give money to the people. Yeah, Maduro already thought of that in Venezuela with fantastic results, and Kicillof in Argentina. It's worked wonders. It never works. So it's not just criticizing monetary policy, but not saying that the problem is the way in which increasing money supply is being distributed, but the problem itself of creating money out of thin air. Every single crisis is generated by the creation, the indiscriminate money creation of money. And the first question is on cryptocurrencies. Now imagine you're a citizen in China, and you see that the country is entering into a debt binge, or that is currently at 260% of GDP, more or less, depends on the calculations, and that it needs 4 times more debt to grow the same, and that things start to look bubbly. But at the same time, the government tells you that you cannot buy assets, that you cannot buy other currencies, that you have capital controls. What do you think? The citizen might not be a financial expert, but the citizen sees, understands that behind it is the word devaluation and monster devaluation. No? So a citizen in Nigeria that sees that the government will end up closing the peg with the dollar and letting the currency collapse, etc. A citizen in those countries is going to say, hold on a second. The purchasing power of my currency is being destroyed. I want some protection to that. That's why you look at an asset, be it cryptocurrencies, be it gold, in which the supply of the asset is not being dictated by a government, which benefits from the increase of that. So, what is the issue with cryptocurrencies? Obviously, that they are not currencies yet. Obviously, no. But citizens start to see that they are a way to escape the inevitable destruction of purchasing power of currencies that is being undertaken by governments. So you say, look, I want to have some gold, or I want to have. I saw an advert by this morning on the TV. It said, I want to keep my money. There was this guy, this actor, I forgot his name, very good actor actually, that says, I want to keep my money. And he had this gold coin, no? So that's the situation, that you're trying to find a way to put some of your wealth, which is in deposits, in something that is not going to collapse because you don't understand in valuations of stocks, etc., but in something in which the supply is not going to be dictated by someone who benefits from the debasement of the asset value. And as such, that's the reason why cryptocurrencies are going through the roof. Are they a bubble? It depends on your perception of where governments are going to go with central bank policy. If you believe that governments, and I believe that this administration has a tremendous opportunity to go back to sound money, and the U.S. needs it as there's no tomorrow. It's go back to sound money, put brakes on the Federal Reserve, be much more diligent about budget design. It will be led by the U.S. Now, if we fall into the central bank trap again, it will not be a question of me or anybody else saying it. Is that citizens will continue to look for ways to protect their wealth in cryptocurrencies or in gold or similar assets.
Good morning, Rafael Acevedo. I am in the Smith Fellowship of the Atlas Network. I'm from Venezuela. Okay, Professor, do you think that eliminating the legal currency of the legal tender of the national currency in those countries where the corruption is very high and there is no legal institutions that protect the economic freedom could be a good incentive, could be a good protection to the society? I'm talking about Venezuela in this.
Well, think about two regimes, same ideology, same type of same economic region, same economic model, very similar. Ecuador and Venezuela. One has survived decently. The other is a complete disaster. What is the main difference, if we look at economic policy, between one and the other? Creating money for the people. One completely dollarized, the other is not. So at least, yes, you might have an issue of debt, whatever, but the reality is that the country has not gone down the disaster of hyperinflation and economy destruction, et cetera, et cetera, et cetera. Same with Argentina. If you think what Argentina did throughout the Kirchner years, massive increase in inflation. What was the big difference to its neighboring countries, even small Uruguay? The main difference was simply currency debasement, was massive destruction of purchasing power of the currency. So at the end of the day, what is the value of a currency? This is the key question, because people think that the value of the currency is decided by the government. It's complete nonsense, because obviously, if that was the case, the Bolivar would be the most valuable currency in the world. Huh? No, the value of a currency is just the value that we give to it as citizens based on the purchasing power of the last unit of that currency. We use a dollar and we accept the value of the dollar because somebody in a couple of minutes ago used it and gave it that value, and the millions of people that used it at the same time gave it that value. Not because the US wants it at a level or another. If it was for the Federal Reserve, it would be much lower. No. So therefore, that is a very important factor. Is countries, I always say that countries should not have an independent currency if they did not have a legal institution, independent institutions, political institution, because that is what it is. It is the physical representation of the difference between this. This is a fantastic thing. Let me show you my $1 trillion note. No? So this is my $1 trillion note. Obviously, every time that I come to the US, I try to pay something with this, and they tell me, and I get very, very, very strong words. Why? Because it's worth nothing. Okay. The difference between the $1 trillion note and this $10 note is not that the government wants it to be that way. Is that you and I decide that this one is legit and that this is a joke.
Terry Miller from the Heritage Foundation. You talked about putting brakes on the government. It's pretty clear what you meant on the spending side, but can you talk about it from the Federal Reserve point of view? What would brakes look like on the Federal Reserve, and what do you think of their current projections and plans of their policies?
I think that the first is, as I mentioned before, is to be systematic. Is to be, you want to protect credibility. I might question it, we might have a debate, but there is credibility within the Federal Reserve, and there is a reason why the dollar is a world reserve currency, and it's not just because the U.S. is a very large country. Russia is also very large, and very few people use the ruble. There is a reason, and there is credibility, and that credibility is generated by the institutions behind it, including the Federal Reserve. So what the Federal Reserve needs to do is to be a lot more systematic about the approach to monetary policy to avoid the market and citizens and the voters from seeing that their policies generate financial crisis. And it's very simple. It is very simple. If I was in the Federal Reserve on a typical Friday and when you present the economic data not so good, job claims a little bit weak, inflation, and the market does like this, I would be very worried, which is what happened so many times between 2009 and 2017. And I think that what they need to do now is to say, look, we're going to raise rates 3 times. You raise rates 3 times. Oh, yeah, but high-yield bonds might suffer. High-yield bonds should suffer. Please. Because if not, what you're doing is actually fueling the bubble of those high-yield bonds. Fair enough. There's a market for it. There is a market for it. At the end of the day, it's so funny that central banks look to be sort of defenders of the market, but at the same time, they don't trust it. So trust the market. It's not so stupid. Huh? And finally, about their projections. The biggest risk about their projections is to try to make the projections politically correct to the voter and to the citizen. Look, the reason why monetary policy was done like it was done was to sort out a risk of liquidity in the market because of the financial crisis. Period. Huh? Now talk to me about jobs. Jobs, what companies create. So I think that what they need to do is to be a little bit more specific about that and present a tailored rule. Say, look, between this and this, we increase rates. Between this and this, we start to unwind. You cannot say we're going to start unwinding the balance sheet for months on end and not doing it, because as a market participant, I'm going to say, you know what, I don't believe you. And that's not what you don't want. That is what you don't want.
Last question. So we'll bury the Phillips curve and resuscitate the Taylor rule. But let me just say, and this is off topic, but very much in the news, if you could just reflect briefly on the situation in Catalonia right now, and then I think we'll wrap it up.
Okay. Well, that's another easy question, huh? to wrap it up. Look, and this is a message for our friends in the United States and everyone that defends freedom. Separatism in Catalonia is not about freedom, it's about bureaucracy. It's not about freedom, it's about installing a state that is completely totalitarian, and the same, it's led by radical communists, and if you look at the documents that they have presented as their allegedly foundation or transition documents, they start from confiscation, they start from intervention, and they start with the complete unification of the judicial system with the political system. So it has absolutely nothing to do with the secession from government from a libertarian perspective. It has everything to do with the creation of a super bureaucracy that has absolutely nothing to do with freedom and all to do with intervention.
Thank you. Well, we have a little something for you, a little gift. After this morning, I'm even less sure of what this is really worth. But I know that it has symbolic value. I hope it does for you to
Thank you
commemorate
so much.
your visit to
Well,
Heritage.
there you go.
Thanks so much.
Well,
We hope to see you.
It has a lot of value for me, and that's what matters. So thank you. It's been an absolute pleasure and honor. Jim, it's always a real pleasure. Thank you so much for everyone for coming. Also, because we counter-programmed the president of Spain, because he's in Capitol Hill with Donald Trump. So that it means even more that you are able to attend. Thank you so much for the opportunity and for continuing to defend freedom. Thank you.